Okay, let's go ahead and get started then. This is Ken at Tortoise Capital. It's the weekly swing trading FAQ session for April 8th, 2018. So what we've done is I'm going to close the book on the FAQs for the January right board. And so those of you that are still on the January course but are playing along, we're going to use the March FAQ right board going forward for any questions and answers or commentary. So that way we're not trying to manage two different groups. I will say I just added the weekend report review for today on the live portfolio management daily podcast. I'm going to resume the portfolio management for the swings. This is just a tough week health-wise for me. I lost my voice during the week and been under the weather generally, so I'm feeling a little better now. Let's see. Let's go right to the right boards. All right, I did not record a session from last week. I thought the lessons were pretty straightforward, but I thought, well, let me go ahead and just talk to these as we go through. So we'll do a combined Q&A. All right, so lesson 5, question number 1, mentioned that the slope of the RL30 is very important. I'm not sure how it can be used to interpret different swing trading positions. So the slope of the 30, as I say here, appears in a couple different indicators and applications. As an example, one of the things that happens, like in a P1, you should watch for 3 signs of improvement, right? So a P1, let's see here. So in a P1, price rolls down and then starts to cross back over, and it has come out of the river, if you will. So this is the Bollinger Band mean of the river, and I'm gonna use the 2 red lines as the Z plus 1 and Z minus 1 as the edge of the river, just to keep it clear. So what happens is on this breakout, the first thing that happens is that price leaves the river, and then the RL10 leaves the river, and then the next thing is the RL30, which was inside the river. It leaves the river. So something I want to just point out. We'll see this later. When all 3 of those elements have left the river, we have the beginning of trending behavior. So this would be the beginning of trending behavior to the downside. And what you'll notice is that the slope of the 30, which started off as flat, now gets worse, and it's following price. And at some point, the RL10 has improved. Price no longer is failing as much. And price is going to oscillate and make this long move back to the top. Okay, so there it goes. And so the slope of the RL30 gives us a little more confidence in the health of the trend. I call it the health of the trend. And now here's a couple ways to play this. The first one is that you now have, when the RL10 crosses the RL30, that's a P1. You got a RLCO crossover outside of the river. So I'm going to draw the river now right here. It's normal for that river to get a little wider as the price becomes more directional. So you might see something, you might see something like this. So this is the Z1 to Z minus 1 stretch of the river. Now, this is where you can start monitoring the slope of the 30. Now, what happens is that when the price has improved enough that the RL30 is no longer failing, and it sort of gets flattened out. I think of that as, I've been calling that the 6 o'clock position, because it's at the bottom of the clock. And then if you think about the owl pattern, there's 5 things that happen in the owl. First, you have an unambiguous move of a certain magnitude. I normally think of that as 1.5 frog boxes. And that significant move begins at the beginning of trending behavior when the 30 left the river. So the fact that the 30 has started to slope downwards and left the river, that's an indication of the health of the market based on the slope of the 30. And then that continues down until you get the second part of the pattern, and that is the RLCO outside of the river. So that's the second criteria of an owl. The third thing that happens is that you get the RL10 has crossed the dragon. So this dragon has come down here, and then when the RL10 crosses the dragon right here, that gives you the third element of an owl. The fourth pattern is that the RL10, the dragon has started to slope upwards. So when you look at the slope, it has bottomed out and started to go. So that's number 4. Now, usually the fifth thing that happens, and the final thing that's needed for the owl pattern, is that the slope of the 30 now has started to roll up. So you get this little hook up. Okay? So one way to answer this generic question about how can you use the RL30 slope to interpret different swing trading conditions? Well, here's one of the ways, and this is on any time frame, right? But an owl pattern tells you that based on the unambiguous move, this move downward, that this symbol is now in play. You have an unambiguous directional move. Then the slope of the 30 begins to improve until it starts to hook up, and that sort of is the final position inside the owl pattern, the final criteria. So that would tell you that that's now a favorable opportunity to take a swing to the long side. Okay, there's been enough price improvement inside this whole region that it went from an unambiguous move down to an opportunity on the upside, and the slope of the 30 was the final element. Now there's some other things that you can watch as this trade unfolds and starts going along. There's a couple other moments that you can now look for that are useful. The first one is the RL30 re-enters the river. The RL30 crosses. I'm sorry, I should have drawn that here. My fault, excuse me. When the RL30 enters the river, it has improved enough from the time that it first started to roll over to the time that it entered the river. There's a little bit of time in there, and the slope continued to improve to the point where it now entered the river. The next thing that happens is that it crosses the Bollinger Band mean. I always look at that as a really favorable moment. In my view, that is the end of the downward trend. The end of the downward trend that featured this unambiguous move down. When the RL30 has come back and crossed over the MA30, I now officially think of that move as over and done. And now it's the long side. And off he's going to go. And now, then the next time you notice the RL30 is when it leaves the river on the far side. So you could almost think of this as a 1, 2, 3 kind of a deal. It it was outside of the river, then it crossed the edge of the river, it crossed the Bollinger Band mean, and now it has left the river. This is also the time when we have the start of trending behavior to the upside. There it goes, right? Because you had the price come out of the river, you had the Bollinger or the RL10 come out of the river, and now you had the RL30 come out of the river. That's the beginning of trending behavior on the far side. So as you notice the slope of the 30 changing, that's what that looks like. Now, that's one way to look at the slope of the RL30. I want to now shift attention to the weekend reports and just show you a couple places inside here where the slope of the 30 matters. The first one is on the market health check. That's this one right here. Now there is there's an indicator right here. The slope of the 30, you'll notice. Slope of the 30. And that's this line right here, this black line, which I'm going to highlight for you. This is not the RL30 itself. It is the slope of the RL30 as reported by stock charts. Now I've gone back and computed long-term averages and standard deviations, and it turns out that let me get this little box off here just a minute. That the key levels in this are on the upside is 0.40, and I'm going to draw that line across 0.40, and then minus 0.22. This sets up between these two lines, plus 0.4 and minus 0.22. That sets up the long-term average plus or minus 1 standard deviation. So the long-term average is right around 0.10. That's the long-term slope average. So whenever the slope of that RL30, like it did right here, gets above 0.4, that makes all of this move exceptional. This extra leg is the surprising move. Because when it hit the boundary of that +1, you would normally expect it to come back and rebound. But it didn't. It took off. And that makes all of this the unusual move. So that's really the second leg of this move up. Notice that. Leg 1 and leg 2. Now, in terms of swing trading, what this really means is that you've got, you can watch this again. Notice I put that little green dot on there. That was the highest high of that RL30 slope, and that's where it rolled over. And then by the same token, this was the lowest low. And look, it came all the way back to minus 0.5, which is right where it is today. Well, both of those are much lower than this minus 0.22. So this is an abnormal move to the downside. This section, and then all of this price action is unusually low. So when you see turning points at extreme moments, that sets up the potential for a very nice reversion to the mean trade. In both of these cases, you see that that's the situation. So not only the slope value, in this case it's going up, but also the extreme limits to what it gets to. That tells you something interesting about slope of the 30. Let me show you another place. Also in the weekend report. It's actually in the daily. So we're going to move. Okay. So some things you can notice on the slope of the RL30. Let's start over here with chart number 1. So this is the blue line is the actual 30-day regression line itself, and you can see it is sloping downward. It's below 0. So on chart number 3, which computes the slope value, the dotted red line is the 0 line. So whenever this blue line goes below that, that means the slope is actually negative. So it was negative all the way through here, but improving, and then it began to be positive right here, and then it stopped being positive right there, which is this motion down. And this is when this was the location where it stopped being negative and became positive. Not for very long, but there it is. When you see the slope get to be more than one standard deviation above average, so the black line is average and the green line is Z1 and Z2, Z minus 1, Z minus 2. Anytime you see this thing move up and then start to roll over or come down here and bottom out, you have an opportunity for amazing swing trades. So here's one. This is where this black line is its own 10-period moving average, so it's lagged a little bit. So what I look for are these little crossover moments. So a crossover moment like this. But I really want to see it outside of the Z1 envelope. I want to see a crossover more than one standard deviation above or below average. In this case, it was at 2, and this one was almost at plus 2. And this was about a 15% sell-off here. And then this one, where it rebounded back up into here, this was about a 12% sell-off that way. And when this reversed, that was a plus 10% move. So 10%, 12% drop, and a 12% drop here. So whenever you see the slope value of the S&P changes its own direction more than one standard deviation from the long-term average, then that's the sign of a potential significant shift in the long-term market condition or the swing-term market condition. So that's a place you can look at. The next place. So this is chart number 23. This is the z-scores of 3 regression lines. Now, it's looking at the RL90, the RL30, and the RL10. And these are all their z-scores. And then the chart that's below it, down in here, this is the actual price compared to the river. So the upper limit of the river is green and the bottom one is red. And so the black line here is the RL30. And I want you to notice that it was more than 2 standard deviations above average and rolled over. It went to -2, went to +1, and now it's back down to -2. And you can see how fast the RL10 changes, and you can see how slow the RL30 changes. That's really the longer term. This is almost like a triple screen of the regression line slopes. And with the 30 being right in the middle, that sort of gives me the primary signal. The other two is the longer term and the shorter term one for timing. And if you go back and listen to the weekend report, what I talked about there was this condition up here was really unusual, because at this one moment you had the RL10 was at 2 sigma, the RL30 was at 2 sigma, and the RL90 was at 2 sigma. All of those had stretched out on every time frame that mattered well above the long-term average. And that equates to this peak right up in here. This was that second leg up that we saw from the health check. And it was at the peak of that and started to roll over. And then you'd see price re-entered the river, crossed the Bollinger Band mean, exited the river for that first big, harsh end of the Trump bump sell-off. Well, the same thing happened now when everything rolls over in this area. That's right here. And you get another big move down. So The slope value of the 30, and by extension of the 10 and the 90, are things that you can use to predict maybe potential sea changes. Like the tide stops coming in, it's going to start rolling out. It's slower than tactical, but it really gives you a insight into the swing term or the swing time frame tides, and I think that should give you plenty of reasons to pay attention to the RL30 as you go forward. Okay. What information do I use to find the most unambiguous move of the day? I like the long-term frog box. And the unambiguousness is when that move, if you see a big move already, that's already the long-term frog box, and if it's aligned with the sector and the market are both going in that same direction, then I consider that to be an unambiguous move. Really, the most extreme form of an unambiguous move for the day is a range stat. If it has moved a range stat in one direction, well, then by definition, that's going to be an unambiguous move. In the hybrid frog system, I really treat a move of 1.5 frog boxes to be unambiguous. And what that means is, the reason I say that is if this is the open, in the hybrid frog, what we do is we take 0.7 of a frog box, or you may make that 0.7 of a long-term box. So that's like 0.7 and 0.7. And then whichever one triggers first, let's say it goes out this way, I take that one short, and then if it gives me 1R or another 0.7, I really treat that as an unambiguous move in terms of the owl pattern, right? So the owl pattern needs to see an unambiguous move. Well, if it has moved one hybrid frog and a second hybrid frog down, each one is 0.7, that comes out to be 1.4. So I'm just going to round that up and say I will accept 0.15 of a frog box in one direction to be an unambiguous move, and then that could be the direction of the move of the day. Now, if it reverses and we get a P1 and then RLXD, dragon rolls up, and then the 30 rolls up, well, we then had that owl entry somewhere down in here. And what I'm looking for here is a move of a hybrid frog or a long-term frog box or a full frog box off the bottom. Any one of those, and now I consider that to be unambiguous, and off it goes. Now, if it moves from the low of the day, a full range stat off the bottom, well, after the fact, that's an unambiguous move. That's why I like to enter after it's moved a frog box off the bottom, because then I might be able to get one or two more moves until it hits a range stat move. Okay? So, number 3. I've started using the triple screen, but other than that, I'm having trouble crossing the bridge of how to apply intraday techniques to the swing signal. This is a set of rules that I would use. Now, remember what you're doing in this case is you're a swing trader and you are moving towards day trading. And so the way you get a little bit faster or a little bit quicker is instead of daily or weekly charts, I would start with like an hourly breakout. So, here was the open, and this is your first hour, and then now here's your second hour bar, and it made a new high, so that's your time to get long. If this was a triple screen and you're wanting to get long. So that's how you might do that. You would still use, I recommend, start with a 2 ATR swing stop for like position sizing. But you may discover that you can start to turbo this entry with a intraday position that's a little smaller than the full 2 ATR. So intraday, what I would do is I would start with a short-term frog box for position sizing, and I would stay with those two standards. Swing trade position sizing, In other words, 1R being 2 times ATR. And then if I was going to turbo, I would use the short-term frog box for the size of the intraday position sizing risk. If you're want to use a 5DD failure with an entry intraday, this might look like this. I have 5 days down, and so now there's my mechanical entry, my mechanical stop, and it opens inside here, and then it just takes out. Now there's the failure. I would take that as a short on a swing, and I would use 2 ATRs for my swing position sizing. So you're using that much as your position sizing. And then if this thing intraday, if it moved a frog box in my favor, I would make sure that I didn't lose money on that one. I might take half the profits and then trail with half a frog box. And that's what I suggest here. Now, a lot of this is really hybrid frog trading that I just described. And that's really more of a day trading technique. And if you do enough of those, you can end up saving some of the move and just hold it overnight. And now you're growing from a day trade, slowing it down a little bit, and becoming a swing trader. So this negotiation back and forth between swing and day can work both ways. Number 4, I don't understand which way to adjust the stops for times of greater volatility. Well, here's what I think about on this. Because an increase of volatility is by definition an increase in uncertainty and anxiety, then we should be quicker to preserve the profits that we make. And so what I use is really the same size stops for position sizing, but I dramatically reduce my expected time in the trade. And the reason is I think I'm going to see the move a lot faster. So let's say on a 5DD, we have some expectation that this thing is going to go become a successful trade. So it's 1, 2, 3, 4, 5. And so here's my entry, and there's my stop. Under regular volatility, I might expect this thing to take 5 to 10 days for it to achieve maybe plus 8% of a gain. An 8% improvement in price. That wouldn't be surprising. And so on a $50 stock or ETF, that might be a gain of plus $4 or plus $5 would represent about an 8% move. And it might take normally 5 to 10 days. Well, if volatility is much sharper, I might see that much of a move. I might see it that fast. Now, in terms of time, this is really good because now I get my gain. I get my 8% gain here instead of 5 to 10 days. This might only be 1 to 2 days. So rather than think, oh, this one is now going to go twice as far by the 10th day. In fact, you got the move that you were entitled to expect, only you got it in 1 to 2 days. Now, if this starts to fail, I'm out. I'm not going to hold on to this thing longer because it got my gains sooner. I just say, hey, I got lucky and I got my money back faster than I could have expected. So in terms of increasing volatility, I am still using the same position sizing stop, and I'm still using the same patterns to tell me when my execution stop is hit. But I am much more likely in volatile times to take the money and run. A bird in the hand is worth these 2 in the bush up here. Take them when you get them. Don't let a winning trade become a losing trade. So during periods of increased volatility is no time to start believing in your trades more. You should believe in them less because it represents an increase in uncertainty and anxiety in the other traders as well. Okay, number 5. In the market health check, there's a statistic called the slope 30, and this is saying in words the same thing that I said on that previous picture about the slope of the RL30. Remember, it's tracking the slope of the MA, and this is in stock charts. It's reporting the slope value of the moving average, not the price value. So it's a little bit different, but the principles of its oscillation are the same. Okay? All right, so let me shift now to lesson number 6. Okay, referring to the squeezed on a daily chart strategy, I'm asking myself, especially in this current market conditions, which has high volatility and the risk Z is in the red, and it's a sideways market. So this is a very difficult market to have any belief in a particular direction, right? So is there a way to trade these candidates for one day only without watching the intraday? For example, a mechanical entry at the high-low with an I stop of the range, trailing 1R. Yes, absolutely. The other way I would say to do that is if you wanted to take, let me put it this way. In times of increased volatility, like it is now, I would only trail it with one ATR on the short side, not on the long side, because you're going to get bigger moves to the downside. I would also consider that you might want to just approach this as it's a mechanical intraday trade where you might pick a target and say, look, let me get just a half of an ATR and let me take the mechanical profit right away instead of trying to imagine it. That one never gives back a full ATR. It only is looking to capture half of an ATR. I think that you would find that that is pretty attractive. So let's say we had 5 days down, and so we might frame it and say, here's where I go long, here's where I go short, and it opens inside here and then takes out yesterday's low. By definition, that's a 5DDF. I might take that short and then trail it, and as soon as it hits a half of an ATR, cash that move. Try that a few times and see if you don't actually like getting paid a full move. You're not even waiting to give any of that stuff back. You can do that without any intraday management whatsoever, and then you simply have a complex order which says, and exit at the close. If I haven't exited by a half of an ATR, then just exit at the close. And what that'll do is keep you from experiencing any overnight risks. Okay? So that's a way to do that. Second one, question 2. In a bear market, do I still play long side bounces? I do, however, because I only expect them to be dead cat bounces, it's the same logic. I want to cash that for a winner. I don't believe that I was able to pick the bottom and then that this is going to be the turning point where a bear suddenly turns into the bull. So I don't believe in this trade at all. I always assume that in a bear market, the further it rebounds, the more inclined the short on bounces guys are going to be. And that's actually, this is at 1, 2, 3. This is a pocket entry on the collapsing dragon. So the collapsing dragon would be this one. And so anything in this little space is the pocket. And I think that is a very high payoff short. So rather than believing in this move, I'm really looking, as soon as I see signs of hesitation, a 1, 2, 3 or a 1, 2, and I'm out. And I'm looking to get short on failure in a bear market. Right? So this is really the same idea as if you read the system definition of the washout pattern. In the washout pattern, the market itself is in a bull, but this one particular thing we're trading is horrible. It's at an annual and a 10-day low, and then gives us just a little hint of a pullback. So this thing plays for that first bounce back to about the 10-day high and then exits. So we absolutely don't believe in that one. I don't want to stick around. I'm cutting and running at the first sign of weakness. And that's the same logic that I would use when I'm going long, but in a bear market. Don't have any belief in those things. If it turns out that this was the actual bottom of the bear, and this thing is going to zoom all the way back up, you're going to have plenty of times to play continuation patterns and re-entries all along the way. So don't believe that you can pick the bottom. In bear markets, cash them when you can, because you're making money in a bear and nobody else is. Okay, number 3. In a sideways volatile market such as this, I believe triple screen, 5DD, and washouts are not meant to go long. That's correct. You actually can, but all of the previous discussions still apply, that you don't believe in it, you cash them when you get them, you don't stick around. Could you take the failure signals for these in this market type? Absolutely yes. Sideways volatile is, a 0.5% away from a bearish market. And because fear is greater than greed, in sideways volatile, I love the 5DDF, the washout failure, and the triple screen failure. Number 4, in the 2016 webinar session, I mentioned being able to swing trade without intraday optimization because of the large down moves. How do I do that? It's the same way that I described above, and that was the idea of play the failure pattern, trail it with a half of an ATR or a frog box, whatever you want, and then cash 1/2 ATR. That's sort of the first half ATR is the easiest ATR of all. That's the easiest money. Everything after that gets a little harder. And if you don't want to try to do intraday optimization, then I think you have to sort of cap your expectations at a half ATR, because you can have a reasonable expectation that could be achieved in one single day intraday. So I'd rather get paid on that. Yes, Griff, I would say that's a good way. So don't believe in the trade. Cash it when you get a profit that's beginning to hesitate. Yeah, a good way to develop that skill is a half ATR. So what I would do is I would paper trade that, and if you got 10 or 20 or 30 repetitions under your belt, take a look at what the average gains are on those downside moves. And then if you ever have an average gain in hand, don't let that turn negative. That will help you time your exits and when to take a profit. I just, when in doubt, when I find myself wondering if I should take a profit or not, I probably should. I should just take the whole thing. When I start telling myself, man, maybe I should just sell half and hold on to it, that's normally a good time to just go ahead and cash it and then get paid. Now, what I would say is this little piece from lesson 5, this little rule set up in here that talks about managing the intraday trades. Take a mechanical entry short, 5 cents below yesterday's low. Use a frog box for position sizing. Trail your entry with a frog box. When you have 0.7 R in hand, move your stop to 0.2 and then trail with half a frog box and then cash 1.5 frog box. You will really be satisfied with that rule set. I truly believe. That's a good place to get started with the intraday trade. If you're primarily a swing trader and you want to begin improving your intraday technique, this is my recommendation for how to do that, because this comes right out of the Frog series, which is really kind of a reliable, low discretion system. It's the hybrid Frog. That's really a painless way to get started on the intraday. Okay. I do. I think that was all the questions and answers that I saw. Um, and we're coming up on an hour here. Yeah. I wanted to show. Let's see. Yeah. So these two, the trade index analysis. If you haven't seen those, are pretty good. I also want to show there was a question. One of the last questions from the January group was asking about a file. Yeah. It was called in the second video lesson. In the second video of lesson 11, I discussed a document called the Intraday Trading Online Workshop Workbook that Catherine Crusoe put together. And so I was able to find I posted it's in the advanced day trading course, but I felt like you guys ought to have that. And so if you go to the files section, you will see the Intraday Trading Online Workshop Workbook. So it's a big file, but it has a lot of good forms and insights into the day trade. So I would encourage you to. Now, the guys that are working together on the Ox Riders, you guys are doing some great work and some good commentary and crosstalk. I really think that's working pretty well. I think you guys are doing a nice job in there. So please keep up the excellent work inside that area. Okay, so that's everything that I wanted to cover. I will get this recording posted on YouTube under it'll be a hidden link, but I will put the I'll put it here under the March groups folder on this right board. It'll be down here under the April 7th lesson. I'll post it in the chat room as well too. I'd like you to stay tuned. I'm looking at maybe a coaching follow-on to the swing course. I think there's what we could be doing after we get through this course is I think what I want you guys to do that are interested in coaching is I'm going to run a test program for the coaching program. I normally charge $3,000 a year for in-depth monthly coaching, but I want to do a special form of that, and I'll put out an announcement where each week you would upload a case study of your own with a video and your own narrative. So you end up talking through your case studies kind of the way I talk through mine. But what you'll find is that you will be amazingly attentive to your own work when you post a video that talks, and I'll have a script for you to follow. And then if we post that link, and then what we'll do is you post one a week, and then you give feedback to one or two a week. And if we get a small group of guys working together, I think you will find that would be an amazing way to further your own understanding. And then I would, as the senior coach, would provide commentary to those case studies in a regular way. And that way it's not just listening to my videos and asking me questions, but now you're putting it into action and then commenting on your own case studies. You'll find that would be an amazing way to learn. So if for the first group of guys that go through that, my intention would be to give you a really deep discount so we can work out the bugs and then reward you for first mover advantage. And I think I would limit it to the first 10 guys, and so I'll give you first crack at it if you're interested, and give you a price break. And then the idea would be is that we could start building like a closed trade journal, but also audio video case studies and not just the static snapshots. I think we'd find that to be pretty powerful. So more to follow. I will offer it to you guys before I offer it to the people in Raleigh. I'm going to Raleigh later this month for an in-person advanced swing course, so I'll give you guys first bite at the apple. Okay, so that's everything I wanted to cover tonight. Pending any final questions, I'll bid you good night, and I'm going to go watch Sporting Kansas City try to beat the LA Galaxy and Zlatan Ibrahimovic, the dreaded Swede monster. So take good care, guys. Be safe, and we will see you in the chat room. This, by the way, there's some primetime trading coming up this week. I mean, with sideways volatile. Well, just listen to the weekend video report commentary. This is prime time for short, sharp moves in both directions. Don't believe in them so much, but trade them and get paid. That's what I'm saying. Take good care, and we'll see you in the chat room.